Accrual basis versus cash basis accounting. Meet Stanley. He works in the accounting department at his company. Accrual basis, cash basis, what's the difference? He's confused. Stanley has a brilliant idea. He'll go see Professor Beancounter. Surely he can explain the difference between accrual basis and cash basis accounting. Stanley is excited to see Professor Beancounter and asks if he can help explain the difference between accrual basis and cash basis accounting. Professor Beancounter suggests to Stanley that first he must take a closer look at the measurement process. He explains that most companies use the accrual basis to measure business transactions. Under the accrual basis, we record revenue in the period that goods and services are provided to the customers, and we record expenses in the period the costs were used to provide those goods and services to customers. Stanley understands what Professor Beancounter has just explained, but then says, okay, what about cash basis? Professor Beancounter explains, under the cash basis, we record revenue at the time we receive cash, and we record expenses at the time we pay cash. Professor Beancounter says, Stanley, let's look at some transactions, and maybe this will help you understand. The first transaction is on January 5th. The company provides yoga lessons to customers on account for $600. The second transaction is on January 15th. The company provides yoga lessons to customers for cash, $300. And the third transaction on January 28th, the company receives cash in advance from customers for yoga lessons to be provided next month, $400. Professor Beancounter decides the best way to show Stanley is to do a comparison of accrual basis versus cash basis to help him understand. Using the transactions he provided, on January 5th, the company provided yoga lessons to customers on account. Under the accrual basis, the service has been provided, so the revenue will be recorded for $600, even though the customer still owes the money. Under the cash basis, cash has not been received, so we defer the revenue until cash is received. On January 15th, the company provides yoga lessons for cash. Under the accrual basis, the service has been provided, so the revenue will be recorded for $300. Under the cash basis, cash has been received, so the revenue will be recorded. On January 28th, the company has received money in advance for lessons that have not yet been provided, so we would not record the revenue. We will defer until the service is provided to the customer. Under the cash basis, cash has been received, so we would record the revenue. Professor Beancounter wants to show Stanley one more set of transactions, this time with expenses. On January 7th, the company pays insurance for 1 year in advance, $9,600. That works out to $800 each month. The insurance policy is good for 12 months. Under the accrual basis, 12 months have not passed, so we would record the expense at the end of each month when that portion of the policy is used. Under cash basis, $9,600 was paid, so the company would record the expense. Next, the company purchases supplies on credit for $600. Under the accrual basis, the supplies have not been used up, so the company would not record the expense until the supplies are actually used. Under the cash basis, the supplies were purchased on credit, meaning the company promises to pay for the supplies at a later date. So no cash was paid, so you would wait to record the expense until cash is actually paid. Last, the company paid weekly salaries of $2,500. Under the accrual basis, the salaries have been earned and paid, so you could say the cost is used up, so you would record the expense. Under the cash basis, cash has been paid, so the expense should be recorded. Stanley finally gets it. All right! Thanks, Professor Beancounter.